Hello and welcome to another develop video. Today taking an in-depth look at Dollar Tree Incorporated, ticker symbol DLTR. We'll dive into financial metrics, assess the company's growth, and ultimately try to find its fair buy price. Dollar Tree Incorporated is an American multi-price point chain of discount variety stores. Its stores are supported by a nationwide logistics network of 24 distribution centers. Additionally, the company operates stores under the name of Dollar Bills, as well as a multi-price point variety chain under the Family Dollar banner. The stock is priced at 200 at 72.4 dollars with a market cap of 15.6 billion. Now let's dive in some key valuation metrics. The price to earnings ratio stands at 13.7 and the price to cash flow ratio is 5.6. The median PE over the past 10 years was 9.9. Over the past 5 years, the company's revenue has grown by 29.5%. Its bottom line has decreased by 120.8%. In terms of earnings per share, there has been a decrease of 231.1%, and notably, the number of common shares outstanding is 217 million, a minus 8.4% change over the period. Now let's assess the company's liquidity and solvency. The interest coverage ratio is 15.3, indicating the company's solid ability to handle its debt obligations. The quick ratio measures the company's short-term liquidity is 0.17. Although this is extremely low, they are a grocery store. And all of these stores usually have very low short-term liquidity ratio, very small quick ratio because they have a lot. Most of their current assets are inventory. So when you deduct them and you calculate current assets minus inventory over divided by current liabilities, then you get an extremely low ratio. But this is not really a problem unless the company has problems selling their inventory, and they do not have those problems, so it's okay. Additionally, long-term debt equity ratio is 0.46, and the total debt equity ratio is 0.46. This is a moderate debt load. Shifting to the cash flow statement, cash from operations stands at 2.7 billion, reflecting a growth of plus 43.6%. Cash from investing activities is minus 2.1 billion with a plus 106.6% change, while financing activities are at minus 530 million, showing a minus 25.3% change over the same period. CapEx has increased by 103.2%, and free cash flow has decreased by 30.2% to 580 million. Moving forward, let's look at the return metrics, see how the company is utilizing its resources. The return on equity is 13%, the return on investment is 13.2%, the return on assets is 5%, the return on invested capital is 9.2%. Finally, let's find acceptable buy price. The first method is conducting a discounted cash flow analysis by using a discount rate of 9%, a revenue growth rate of 5% for 10 years, and a perpetuity growth rate of 2%. We get a fair value of $62.53. Secondly, using a multiples valuations of 15 forward price to earnings, 15 trailing 12 months operating cash flow, and 17.5 times free cash flow, we get a fair value of $106.3. And finally, the target price is $80.96. Putting it all together, we get an intrinsic value of $83.3. And using a 15% margin of safety, you get an acceptable buy price of $70.8, suggesting that the stock at the current levels is undervalued. Trap analysis are Dollar Tree as a whole. Now, they are definitely at a low valuation. They are a company which still has some room to grow, but for me, it's just that they are a grocery store. I don't really have a problem with these types of businesses. Of course, Costco is a great company that has managed to grow extremely well, but these types of businesses are not really that, I don't know, I don't really like them since you basically pay the same multiples you'd pay for a REIT or for something else, and you get half the return or three quarters of the return. So in this case, Dollar Tree is not really that great of a company. As you can see, their free cash flow is decreased because they are forced to do huge capex to increase their capex hugely, so that they can actually manage to grow their revenue and their net income and operating cash flow. So this type of business is very capital intensive, and it's not really that fast in terms of growth. This is not a great company, don't get me wrong, but as I've said, this is just not that type of opportunity. There are much better opportunities out there in the market. Even today, when the market is pretty overvalued, there are still some companies which are much better buys, in my opinion. But this is not really that far from a buy. I think somewhere about sub 65, sub 60, this would be an instant buy. Of course, you should do your own due diligence. That's the most important part. This is just a short analysis based on a few numbers. But yeah, I believe this would probably be a buy at sub 60. And this is not really a bargain, even at 60. This would be a bargain at, I think, 50. This would be the perfect price. But realistically speaking, I don't think it will get to 50. If you manage to get it at 60, then yeah, it's pretty good. But as I've said, this is not really an extraordinary business. This is not really a bad business. It's just too mediocre. I think that's the right word, mediocre. Um, Now, thank you for watching. If you found this video helpful, please like and subscribe for more deep analysis. And also check out my investing blog featuring in-depth analysis from the link in the description below. See you in the next video. Bye.